everybody. Good afternoon. Thank you for joining us on another Power Play Tuesday edition. Apologies for the short delay here. Thank you for your patience. We were experiencing some technical difficulties, but we're up and running now. We have a great presentation today. We have Ben Suttles from Disrupt Equity with us today. He's going to be talking about the 10 biggest risks in commercial real estate investing and how to mitigate them. Without further ado, let's actually go ahead and jump right into it. We'll have a Q&A session right at the end, but for now, let's bring up Ben and get started here. Hi, Ben.
Hi, Andrea. Thanks for letting me come on. I apologize. I was the one that was having the technical difficulties. I'm a lot better at real estate than I am at IT, but I'm excited to go through my presentation and hopefully add some value today with your listeners.
Of course. Go ahead, please.
All right. So today, everybody, is what is on everybody's mind. It's in all the news cycles. What is going on with commercial real estate? What's happening with interest rates? What's happening with inflation? Doom and gloom everywhere. That's just all we seem to hear. And obviously that sells news, right? Is there some validity to some things? Yes. Is some of it overblown? Absolutely, right? So I'm talking to you from Houston, Texas, Ben Suttles, Disrupt Equity, and I'm going to go through the 10 biggest risks I see in commercial real estate and how to mitigate them. So we're going to get right into this today. So let's go to the next slide here. Bear with me here there we go. All right. So there you see my beautiful bald head there. Again, Ben Suttles, managing partner of Disrupt Equity. We've been doing this for about 10 years. We bought and sold over 5,500 units, currently have about 800 million in assets under management. As we had talked about earlier, we are based here in Houston. We've had a lot of different exits. Those are just some of the ones there down at the bottom. So I kind of know what we're talking about here. We're a vertically integrated firm. We have our own property management company. We have our own construction company. We have in-house asset management. We take this stuff seriously. We are not one of those fly-by-night syndicators that you're hearing about, on the Real Deal or some of these other syndicated, kind of newsletters and, press releases here. But, one thing that I'm really, really excited about is we're the number one fastest growing company in Houston last year, and we're the second fastest growing company in Houston this year too. So, really excited to kind of dive into this. But what are you guys here for? You're here to talk about the risks in commercial real estate. So overpaying for an asset. Right. I think that was what got a lot of guys and girls in trouble the last few years. Right. We were kind of in this frothy, peak in the market. And that's where a lot of people got into trouble. Right. But ultimately, we have to get back to the basics. Right. Buying any real estate at a great basis, whether it be commercial, whether it be multifamily, whether it be single family. And both me and my business partner, Ferris Musa, started in single family. It's all about getting on a good basis. Right? Buying in a good deal. That's where they always talk about, you make the money on the buy. Why do they say that? That means that you lock in equity when you buy it at a good discount or at a good basis, right? Don't get caught up in the hype. A lot of people, at least over the last few years, were just kind of this almost fear of missing out on something, the FOMO, right? And I think that's where you can make mistakes. And so you have to understand that, this is a business, that there's ebbs and flows, there's market cycles, there's risks involved, right? And that ultimately you shouldn't just hop in because your buddy's made some money on something, or you heard that multifamily or commercial real estate was a hot asset class, right? You need to understand how the business works. You need to understand how the financials work, how to underwrite these deals effectively, and ultimately how to go out and execute a business plan, right? I think the other problem that a lot of people had over the last few years, and we'll kind of get into some of this stuff, is that they just didn't know how to execute a business plan, right? So keep moving along here. Risk number 2, buying in the wrong markets, right? Trends matter. And what do I mean by trends? Ultimately, population and job growth drive a lot of what we do in commercial real estate. It's all about supply and demand, right? So let's take multifamily, which is what that's kind of our bread and butter. And ultimately, one of the most important things to understand is supply and demand dynamics, right? So let me give you an example. We're here in Houston. We're here in Texas. We love Texas. We invest in Texas. There's a ton of people and a ton of jobs moving to Texas. What do those people need to live in? They need to either live in a single family home or they need to live in an apartment while they're going to these new jobs. And ultimately, there is not enough supply to keep up with the demand, right? And so what does that do? That ultimately gives you as a landlord pricing power, right? Now it's all kind of somewhat market driven too. So each market and even each pocket within a bigger market is going to be somewhat different, right? In terms of the demand drivers and what might be around there. Is it in good school districts, all those good things, right? But ultimately, you need to be deciding, hey, I want to invest with some tailwinds, or do you want to invest with some headwinds? California, excuse me. I didn't say that out loud, did I? But bottom line is you want people moving to your state or to your market. You want people to have demand for the thing that you're supplying, right? It's just business 101 stuff. And so that's what I mean by trends matter. Rent growth, these are the things that you can kind of determine, right? Is rents going up in the area? Are they going down? Are they staying flat? You need to understand that. And each market's going to be somewhat different. Right now, there's a little bit of softening across the board, but there is still certain pockets that we're invested in where rents are still going up, right? And then some of that's tied to inflation. We get it. Some of it's tied to just natural organic rent growth because the markets are good, right? Median income. Why is this important? Well, ultimately, you need to be able to have renters that can afford the rent that you're charging, right? And so if you, just to give you an example, I'll take a wildly just off base example, right? Say the median income is $30,000 in the area that you're wanting to invest in. You find this apartment, median income's $30,000, but your business model is to jump rents to $2,000 from $1,000, in that market. Well, I'm just going to tell you right now, they're not going to be able to afford that rent, right? So understanding median income in that area is important. Having a diversified economy. We invested in Beaumont. Love Beaumont. Beaumont's got a lot going on for it, but ultimately it's still tied very, very much to the port and petrochemical. And when those things kind of start slowing down, the whole market just starts kind of slowing down, right? Whereas Houston, believe it or not, for those that are not here in Texas or in Houston, is very diversified at this point. It's got a lot of medical, it's got a lot of manufacturing, it's got a lot of transportation, it's got tech, right? On top of obviously the oil and gas, right? And so ultimately, it's important to invest in markets that have multiple things happening for it. So if that factory shuts down, or or ultimately that economy, that part of that economy starts slowing down, whatever it might be, you're not exposed to, people not being able to pay the rent or having to move to another market because the market's bad. Markets matter, right? First risk and first mitigation is buying the right deal in the right market, right? Those are the most important things, right? Not having enough cash reserves. That's what people are going to get in trouble for in the next 12 to 18 months, folks. And that's really where I think there's going to be some buying opportunities. So just need to be keeping your ear to the ground. And it's not because, they didn't buy it all cash or there wasn't any leverage. Ultimately, these people were over leveraged, which I'm going to get into here in a minute, but they also just didn't have enough cash reserves, right? So inflation hit them, then interest rates went up. Right. And even if you had an interest rate cap, and I don't really have a whole lot of time to explain that on this presentation, but even if you had an interest rate cap, which essentially caps how much the interest can go up, these people are still paying tens of thousands of dollars more a month in their note than they were before. Right. So the old rule of thumb was 6 months of expenses and debt. You should just park it in a bank account. Right now, I'm telling people to double that. Right. At the end of the day, it's important to have cash reserves because you just don't know how long the slowdown is going to happen or going to last for. Then ultimately, if you are sitting on a deal where you're in kind of a bridge loan or a variable interest rate loan and you want to eventually refinance, you might need to bring some cash to the table. It's called a cash in refinance. It's not as sexy as a cash out, and so how are you going to do that when you have no money in the bank? So, having enough cash reserves is really, really important. And I just don't think that a lot of people did that. Right. So having the wrong capital stack on your deal, loan plus equity. What the heck is a capital stack? Right. It's just this, clever PE/MBA term, which is essentially how you're structuring your deal from what kind of a loan are you putting onto it to what kind of equity are you going to put on it? Do you have pref equity? Do you have a preferred return on your equity? All of these different creative financial engineering things that people kind of throw around just to sound like they're smart is ultimately important in a lot of ways, right? Because what ended up happening over the last 3 years is that people were buying at the top of the market without enough reserves, sometimes in really bad areas, and they're ultimately putting way too much of a loan on it. right? So we talk about it even in the single family world, right? Where you're not over leveraged. Well, this is essentially what I'm talking about, right? Where you have to balance the deal between how much do you take out on a loan and how much equity, which is cash, do you bring to the table. And in a lot of ways, the last 3 years, people are bringing way too much of a loan to the table versus equity, right? And then what ends up happening when your interest rate goes up 500 basis points, you can kind of do the math, right? You're going to be in trouble. And then if you don't have the cash reserves, then it's just a death spiral and you're eventually going to lose the deal potentially to the lender, right? So don't over leverage. And I'd say that that's probably, something that you shouldn't do in any part of the market. We typically are leveraged 50 to 60% on all of our deals, or our competitors were leveraged all the way up to 85% in a lot of ways. So putting long-term permanent debt on a short-term hold can also kill profits. And what do I mean by that? That means if there's a deal that needs a lot of love, it needs a lot of rehab, you're going to put a lot of money into it, you bought it at a great basis and you want to flip out of it and really take all those chips off the table in the future, putting a long-term fixed rate loan on it is going to come with some prepayment penalties. And ultimately, sometimes those prepayment penalties can be onerous, very onerous, like 10, 20, 30% prepayment penalty on those deals. And that's going to kill your profits. Right now, I'm talking out of both sides of my mouth. I'm saying bridge, it maybe is a little dicey right now because of interest rates, but I'm also saying there's certain deals where bridge is a tool and a mechanism that you should use depending on your business plan. Right now, let's take the other side of the spectrum where you have a deal that's more stabilized. It's a sexier deal in the sexier part of town, and it's already 95% occupied. You're going to put some little bit of money into it, but it's already done. It's already there, and you want to hold on to it for a little while. Those are the deals that you put the long-term permanent financing on. You get that fixed rate, you lock it in for 10, 12 years, and you just let it coast, right? Those are the deals that you're not going to sell for a while. So the prepayment penalty eventually burns off. It just kind of goes down the hill as long as you're holding on to it, for typically 5 to 7 years. By the end of that 7-year period, most of it's going to have been burned off by then, right? So putting the right capital stack on the right deal is very, very important. Right. So kind of diving a little bit more into some of these terms that I'm talking about. I'm talking about permanent versus bridge. You're like, what the heck is this guy talking about? Well, permanent loans have fixed rates. They're typically longer term holds. Like I said, 7 to 5 years. I've also seen it as low as 5. I've seen it as high as 20. Then it's got those big prepayment penalties, which we just talked about. So if you sell before the end of the term, you could have 10, 20, 30% prepayment penalty. It's good for stabilized deals versus bridge is going to have that variable interest rate. Better buy that rate cap like we talked about. That's just a hedge that makes sure that your interest rate doesn't push up behind that. And if it does, then the cap pays off the difference. There's typical for shorter holds, 1 to 3 years, little to no prepayment penalties, right? So that's the other benefit of it, and good for properties that are not stabilized or need a lot of rehab or love. Right. Right now, what you're going to see is a lot of assets have been rehabbed, but there's a lot of distressed sellers or partnerships. So, you're still going to get into a situation where maybe bridge is the only thing that makes sense because the deal operationally is not there, but there's not a lot of money that you got to put into it either. So you're going to have to balance those things. And ultimately, each deal, each market, and really what your investor returns or what their expectations are of hold periods and returns is really going to drive these things. And, we use a company called Peak Financing. They're a mortgage broker. Anton Matley is one of the smartest guys that we know, and he really is able to kind of help structure these on a deal by deal basis. And you need to talk with him or a good mortgage broker and have them kind of size up the deal and give you the options that you have in the market, right? Risk number 5, rising interest rates. We've been talking about this thing for 2 years, right? Buy that interest rate cap. Again, it's a hedge. Look it up there. It's all over Google. Chatham is the company that we use, just to give you guys some industry referrals that we use is the the company that we buy our interest rate caps from. If you can go in lower leverage, Fannie and Freddie have those fixed rate products. They're friends in the market. They are there to provide liquidity right now, and they are. In a lot of ways, they are there to not only provide liquidity, but they're also there to make sure that that affordable housing is in place, right? That's one of their charters. And so, they're always going to be in the market. It's not like 2008 and 9. This is a totally different scenario than it was the great financial crisis. And they're still lending. Now, they're going to lend on lower leverage deals. They're going to lend on more stabilized properties. and then they're ultimately going to look for, is there an affordability component to the rents that you're charging? And that's ultimately going to drive how much loans they're going to give, or how much of a loan they're going to give you on the property. But ultimately they're still there. And some of the rates, I mean, 10-year treasury just kind of gone down. We're right around 6%, 6.25%, right, is what you're going to get from Fannie or Freddie versus a bridge loan, which is probably right now anywhere from 8 to 10%. Right. So you can kind of do the math. If you can take on a little bit lower leverage, bring a little bit more equity to the table, in my mind, a lot safer, you're going to be paying 300-400 basis points lower in interest each month. On big properties, that is going to add up quite a bit. Right. So just be aware that rising interest rates are a thing. Now, everybody's, where's my crystal ball? If I knew what Jerome Powell was going to do and what the Fed was going to do, I'd be a trillionaire by now. But ultimately, don't go against the Fed, right? Go with them, understand which direction they're going to go. Right now, I think they're pausing. I think they're looking to see what their interest rate hikes that they've done over the last 2 years are going to, how they're going to affect the economy. And it's a little bit of a wait and see. Now, if inflation starts tearing the other way, they might raise it again, right? Nobody really wants that to happen. And especially going into a presidential, election, they're probably not going to want them to do it quite a bit next year, but you never know, right? And ultimately, they're not necessarily beholden to political pressures, so to speak, right? But right now, I think my prediction, don't hold me to it, is they're going to hold, and then eventually, probably towards the end, or at least the middle to end of next year, they'll start slowly decreasing, and the decrease will be a lot slower than the increase was over the last 2 years. So, risk number 6, not having the right insurance. And again, another hot button issue, especially if you're in Texas. People have been complaining about this for 2 or 3 years. And it's not necessarily Texas. Now, Texas, we took a little bit of hit after Harvey, obviously. For anybody that's here in Houston, we had the freezes, which really kind of, that was a freak thing that insurance companies just, they just know might potentially happen over a course of decades. But really what we're paying for right now is those 2 hurricanes that were in Florida the other year. Those cost tens of billions of dollars. It wiped out a lot of really, really pricey real estate. And ultimately, insurance companies are for-profit companies. Now, we have a partnership here in town. It's a Strategic Insurance Group. They have a fixed rate, and they can quote on that fixed rate throughout the year. So for whenever I'm going to buy deals, I have an idea of what I'm going to be paying for that property insurance instead of something all over the map. But ultimately, working with just an experienced commercial real estate insurance agent, specifically somebody, if you're doing multifamily, that knows multifamily, it's different than office, it's different than industrial, it's different than retail. And definitely, not to hate on anybody that might be working for State Farm or Allstate, obviously, we know those folks too, probably aren't going to be your best bet. There's very specialized types of insurance products that are done for commercial, and you need to be working with somebody that's experienced. And don't cheap out on coverage. I tell the story. I might have even told it on a Quest, presentation in the past. I had a property in Beaumont. It flooded during Hurricane Harvey. I had an $8,000 FEMA policy on it, and that I almost canceled because we weren't even in a flood zone. Well, then lo and behold, Hurricane Harvey came, and guess what? 32 units flooded, and I ended up getting a payout of $2.5 million on that $8,000 insurance policy. So ultimately, I know, especially with insurance going up, that it's an easy, let's just jack up our deductible, or let's lower the insurance that we have on the property. That seems good in tough times when you're just looking at the dollar amounts. But why do you have insurance? You have insurance for when there's a catastrophic thing that happens. And sometimes that happens, whether it be a flood or a hurricane or a tornado or a fire. There's a lot of fires in apartment complexes. And if you don't have the right insurance in place, you're going to be coming out of pocket on a lot of that stuff. You're almost essentially self-insuring, right? And then ultimately, for people that are here in Texas or really anywhere there's a flood zone, make sure that you check the FEMA flood map. There's this easy, cheap, free resources online that you can determine if you're in a flood zone or not. And if you are in a flood zone, not only probably will your lender expect you to have flood insurance, but you should just go ahead and do it anyway, even if they don't. It's just, again, like I told the story just a minute ago, it's money well spent. So moving along, risk number 8, property taxes are going up. We've heard this well, at least here in Texas, we always complain about property taxes, and we fight them every year because that's just what we do here in Texas. And, it's a little bit of a cat and mouse game, but bottom line, they're going to continue to go up. Now, there might be a little bit of a stagnation of it over the next couple of years, just as we kind of have a slowdown in the economy. Typically, the appraisal district's a little bit of a year and behind. So, say, for example, they're going to look at 2023 values. They've gone down or they've slowed down. So the increase going into 2024 is going to be less, or at least that's the hope, because typically they're a year behind, and I think you're going to also probably get that benefit going into 2025 as well, and then they'll probably make it up once the economy starts going back the other way. But bottom line, when you're in these property tax protest states, hire an expert. Don't be the guy or gal that's going to try to put the whole packet together and go down the appraisal district and be the person that's going to get in front of the appraisal board and fight the good fight. I get it, and some of you guys are probably rolling your eyes saying, "I've won one." That's great, and I'm not trying to ding on you on that one. It's more so when you're talking about big commercial properties, a lot going on to it. It's not like your single family home, right? And they look at it several different ways, and so hiring an expert. There's a lot of them here in town. Connor, Ryan, some of the big ones. Talk to those guys, get their proposals on what they think they can take it down to and how much that's going to cost, right? And ultimately one thing that people don't realize, and even here in Texas, is that you should only be paying property tax on the bricks, sticks, and the land. In a lot of ways, you're paying for all of everything, the brand, all of the everything that's intangible on the property, which in some cases could be millions of dollars worth of value. The appraisal district is trying to stick you with. So there's strategies involved where you can tear out that intangible value and really kind of get down to the brick, sticks, and the land, which is ultimately all you're supposed to be paying property taxes on. So there's strategies. Those expert consultants should know that. That's the most important thing. And then ultimately, we're here in Texas, and even if you're not, why should we be giving up our money to the government, right? Protest our taxes. That's our right. They're almost expecting it. And so if you don't, you're just giving up the fight, right? So I say protest every single year, even if you feel like you got a fair valuation. Can't hurt. The worst thing that they could say is no, right? So risk number 9, investing with inexperienced operators. Now, we all started at zero. I was at back in 2014, whenever I started in multifamily, I had nothing, so I get it. Sometimes you have to go out on a leap of faith with certain operators, but this is not the time to be doing that. Right now, it's too dicey in the market. Some of these properties are going to have real challenges, going to have real turnarounds that they're going to need. And ultimately, trying to invest with somebody that's just getting into the business and taking on a distressed property. I'm an LP on 28 deals. I think that just sounds very, very risky, right? Because ultimately, what are you doing? You're backing the jockey. You're not backing the horse. Right. And what do I mean by that? I mean that you're backing the person that's going to go out and execute the business plan. Yes, buying in the right market, buying the right property, that's important. But those are always secondary to who am I investing with? And do I like, know, and trust those people? Right. That's the most important thing. So some of the things that I look for, again, I'm invested outside of our own projects in 28 deals, vertically integrated firms, people that have their own property management company, their own construction company, their own asset managers. They are fully integrated and doing this day in and day out. They have a strong track record. I mean, obviously that's important. Lead with integrity and are trustworthy fiduciaries. Ultimately, what do we do here at Disrupt? We are fiduciaries. I am taking money as an investment, and then I am packaging that and investing that into a commercial real estate opportunity. Right. So what keeps me up at night is making sure that I'm not only returning money to my investors, but getting the return on their money as well as fiduciaries. And then again, reminder that you're backing the jockey, not the horse. And I think that's important. People they get caught up on, this is just a sexy property and a sexy market, and then they forget to do the due diligence on the operator. There's a lot of slime balls. There's too much money to be made in this business. And it attracts people that maybe would give other good operators a bad rap. So do your due diligence, do credit checks, do background checks, ask for referrals and references, ask questions when you're reviewing the deals, ask them how much skin they have in the game. We put 5 to 10% of all the equity that we raise into our own projects, so that's our own money going into these deals. And, I see people that are taking big fees and they're not putting any money into the deal. And then you gotta wonder when things go bad or things slow down and they've got challenges, are they going to step up to the plate? They have no money in the game, right? So you got to think about that. And when you're investing, that's probably one of the most important things that you should be thinking about. Do they have skin in the game? All right, risk number 10, the macro economy, inflation, unemployment, interest rates, World War III. We got all kinds of things going on, right? So the solution here is, again, cash. Not only is cash king, but cash reserves are king now, right? Don't fight the Fed like I talked about earlier. CRE, commercial real estate, is hyper local. Yes, there are some macro economic things that you need to be aware of, especially when it comes to loans and lending and interest rates, right? Because that's really a macro thing that gets driven by the Fed and, political policies and, inflation and some of these other things that are happening at a macro level. But ultimately, real estate and even commercial real estate is hyper local, right? So what's happening in California might be different than what's happening in Texas, might be different than what's happening in Florida, right? And so you need to take that into consideration and don't get caught up in the last news cycle that you heard from CNN or Fox News. They're just trying to sell ads, folks. So they're going to keep you perpetually on your toes and scared and wanting to tune in to find out what next horrible thing's happening, right? And one of the biggest things that I always talk about multifamily, which is what I love, other than a big supply and demand imbalance that we have, especially here in Texas, where there's more people moving here than we have housing, is that there's a hierarchy of needs. You need water, you need food, you need shelter. You don't necessarily, and I'm saying this standing in an office building, you don't necessarily need an office. Now it's nice to collaborate and have teams and all that stuff. And we have that here at Disrupt, where we have 220 employees. But ultimately, you don't need that. You don't necessarily need that retail outlet center, right? But people need a roof over their heads. And I think that that's something to take into consideration. That's why multifamily is one of the most proven and tried and true asset classes and will continue to be into the future, right? And like I said, can't say this enough, turn off the news, right? They're there to scare you, and ultimately they're doing a good job with a lot of people. So bottom line, is now the time to be buying real estate? Reason number 1, don't wait to buy real estate and wait. I love that quote, right? Think long term. The time for the 2 to 3 year flips is over. So for some of you that I know we even have Quest investors on our deals. You guys have been in the multifamily syndication space for 10, 15 years. That 2 to 3 year flip was pretty much customary for the last decade. That's no longer going to be the case. I think you're probably in it for 5 to 7 years at this point. So you need to start having a longer term horizon. But bottom line, the fundamentals are strong for multifamily. Again, we got a supply and demand problem. We got an affordability problem. They're not making class C and B product anymore. Everything that's going to be coming out of the ground over the next 5 to 10 years, and there's going to be some years where there's not going to be a lot of product coming out at all, is going to be A+ stuff. For the guy that's making 30, 50, 60, 70 grand, they can't afford a house. They certainly can't afford to pay $2,000 or $3,000 in rent on an A+ property. So where are they going to be living? They're going to be living in that workforce housing, model and property. And so there's a lot of fundamental tailwinds that are great for multifamily. Reason number 2, demand is outstripping new supply, especially in a lot of the Sunbelt markets. Again, we talked about this before, right? There's more demand than there's supply. Strong job and business-friendly economies will drive growth for years to come. It's not some Republican talking point that Texas, Florida, and the Carolinas and some of these other kind of, red states and Republican-led states are doing better than their blue state counterparts. And I used to live in California for 10 years, folks. Don't throw stones at me, but it's beautiful weather. I met a lot of great friends out there. I still have a lot of great friends out there. But bottom line is, right now, the Republicans and the red states are driving growth through, obviously being tax friendly, business friendly, landlord friendly. That incentivizes companies and people to move here, right? Because they're not getting a lot of their money taken from taxes. And, it's ultimately incentivizing people to start companies and move companies that were already started somewhere else to here because they're wanting to look out for the best interests of their employees. And I love that, right? So invest in, markets that have that going for them. Reason number 3, transactions are down, but there's still a lot of buyers on the sidelines, leading to more favorable pricing in terms of sellers needing to exit their deals. What does this mean? That means deal flow is down. Like it's down like 70, 80%. And, in comparison to the highs, right? So what does that mean? That means that if there's sellers, they're either distressed or they're just coming up on a term and they have to sell. It doesn't necessarily mean that the property's bad or that they're even in a distressed partnership. It's just like, hey, I've got a loan coming up. I've got to sell. Well, then they're going to market. There's not anybody there to buy it, but they still need to sell. So what can you do? You're going to get more favorable pricing. We're already seeing prices that have dropped 20, 30%, folks. On some of these Class A deals, we're seeing discounts of 30 or 40%, right? Because they bought these Class A deals at the top of the market and now they can't sell them. I'm getting better returns. There's no longer are the days of putting hard, non-refundable earnest money. I am dictating essentially the price and the terms that I'm going to buy it out and take it or leave it. And, most of the time they're going to take it because they have to sell, right? So what do I mean by this? It's just, you are now in a pole position as a buyer. It's a buyer's market in commercial real estate. It's not a seller's market. It used to be a seller's market 2 to 3 years ago, not anymore, right? Number 4, Fannie and Freddie still a multifamily, still a lot of liquidity in the market, unlike the great financial crisis, right? Back then, there was no credit. Fannie and Freddie were going defunct. Remember that? Remember when we had to bail them out? Well, that's not the case anymore. They were actually gotten smart and they fixed a lot of their problems over the last 10 years. And ultimately they are still there to provide liquidity and they're still lending. They're still doing refinances. They're still lending on new acquisitions. They're still lending on new construction. There's all these things that are happening, and ultimately, if you've got a good deal, there's going to be a debt provider or a lender out there that's going to be able to provide the lending on that. Reason number 5, be greedy when others are fearful. I think this was Carnegie might have said this, right? There are billions of short-term loans coming due in the next 2 years. And those folks are going to have to sell at a discount, right? They're going to need to sell because they have to get out of their loan. They're not going to be able to refinance because they bought it at the top of the market and they're ultimately going to be underwater when they go to refinance. So they're going to have to sell at a discount. Do you want to be the person coming in, swooping in and buying those great deals at a discount? Or do you want to be the person that's trying to time the market or, I heard on CNN that it's still not a good time to be investing in real estate, right? Ultimately you need to kind of take action and get into the market. And I think 2024 and going into 2025, it's going to be the best 2 years of buying that you're going to see in the next 10 years. Because you're going to be able to get things at such a discount. And we're going to look back and say, this was the bottom. This was the bottom. So, I'm calling it, if I'm wrong, it is what it is, but I'm putting my money where my mouth is. We're still buyers. We'll be net buyers next year. And ultimately we think that there's going to be some great opportunities because of all this distress that's in the market. So stay in touch. Again, Ben Suttles, check us out, team at disruptequity.com. We got a lot of YouTube content. We got a lot of stuff on Facebook. So find us on all the social media channels. Got a little QR code right there, but I'm going to go ahead and pause, take a breath. And then ultimately I'm open, Andrea, for any questions that anybody might have.
Excellent. Thank you so much, Ben. That was really good, valuable, and insightful information shared with us today. That's awesome. I'm going to encourage anybody who's joined us and who's with us to put their questions on the chat. I'm going to actually take about 5 minutes and go through some slides on my own. Just 1 second here. I just want to share with you guys a couple of things and promotions that we have going on today. First of all, of course, the disclaimer, all the information shared here today is for educational purposes only. Quest Trust Company does not provide tax, legal, or investment or structuring advice, and all parties are encouraged to consult with their attorneys, financial advisors, accountants before entering into any type of deals, okay? So we always go through that. This is a QR code if you're looking to talk to one of us, an IRA specialist, if you have questions, if you're ready to move forward, if you have a deal with Disrupt Equity that you want to move forward with your IRA, by all means, go ahead and scan this QR code to set up a consultation with us. It's complimentary, and we'll get with you and we'll get you all set up there and take you through the process. Or if you have any questions or something you don't understand, we can also do that. We're always happy to help and educate. So go ahead and do that. I'd like to talk a little bit about our gold family experience here as well. This is for people who have you can have upwards of 10 accounts. And of course, your family members can join as well. It's for a fee of 3,000 a year, but you have great service. You have a concierge type of service. You'll have priority on a lot of things like funding and processing times. It's a really great and actually very cost effective way to, when you have multiples, like I said, multiple accounts that you need um, to have here together at Quest. So check this out if this is one of you, because it's a really good fee schedule option there that we offer. Rewards for deposit. We're running this promotion for the first 2 weeks of December. This is pretty cool because if you move in certain amount of funds, then Quest will credit you, $500, $250, or $125. So, check this out if you're looking to fund a deal. Definitely take advantage of this and use this coupon code, okay? Existing clients, this applies for you guys as well. So it doesn't have to be strictly a new account, okay? And then last but not least, we have our Save the Date Quest Expo. I believe we're still doing early bird tickets. This is going to be an amazing event next year. And it seems like we're a little bit away from it, but time goes by really fast. So make sure to check it out and to purchase your tickets to join us there, because it's going to be amazing in June next year. So that's all I have in terms of slides. And now let's bring Ben back up and let's go over some of the questions. So Ben, I'm not sure if you see the question or if you want me to read it.
I've got Greg's question. If the loan is fixed, why the need for the cap? How is there not a requirement for a cap on an arm? I thought FHLMC and FNMA require a cap on the arm, and when that cap runs out, you need to purchase another. All right, Greg, great question. If you have a fixed rate, you don't need an interest rate cap, right? It's two. That's why I was trying to make a distinction between a permanent loan, which is fixed, and a bridge loan, which is obviously what you're referring to as an arm, right? It's a variable interest rate loan. In that case, you do need an interest rate cap. The lender will typically dictate what the strike is, which is how high up above the prevailing rate you need to go where the cap would actually kick in, right? And we need to take a distinction away from FNMA and FHLMC. When you're talking about bridge loans, none of that stuff really applies. Bridge loans and commercial real estate is kind of the Wild West. It's not very regulated. Really the lender is going to dictate if you even need an interest rate cap. There is some that don't. In fact, there's people that we know in the market that don't have interest rate caps, and they are getting smoked right now. Whereas call it a Freddie Mac, there's a product that they have, it's called a floater, which is essentially a variable rate loan. Freddie Mac also dictates that you need to have an interest rate on that, or interest rate cap on that deal. So two different things. A good question.
Awesome. This question I can take, actually. How do we access the recording of the webinar? So as soon as we're done here, actually, it's going to be posted on our YouTube channel, on our Facebook channel, I believe, as well. So you'll have access to it right after we're done here on our YouTube channel, okay?
All right, Steven's got, what other commercial properties do you buy or like besides multifamily? We're also doing some development. Development's very tough to get financing on right now, so we're working on some seller financing deals for the land, and ultimately going to bring them to market when there's really not going to be a lot of supply coming online. We like that. We've also been a big fan of self-storage in the past. We don't typically do it right now, because ultimately there's, we're a big fan of like, hey, go deep on one thing and be a specialist on it versus trying to get too caught up in doing too many random things. I also like the private equity space. I think that there's a lot of opportunities in buying businesses, especially with, where, kind of the baby boomers are and their retirement process and, people coming up on retirement without succession plans. I think that's going to be another space that's going to be very, very interesting. And I think there's also going to be a lot of consolidation even within the real estate space. We see it on property management companies a lot, but I think there's going to be a lot of syndicators that are going to try to team up, and there's going to be some consolidation too, which I'm interested to see how that plays out as well.
For sure. I think that's all we have for now for questions. Actually,
I see a couple more. Yeah. So Jay, I mean, as a fiduciary, what's your assets under management? I think I mentioned that earlier. 800 million is currently what we have under management. We've done, a couple $100 million more than that, but we've obviously divested from some stuff. We've raised $250 million as well. So that's when I say fiduciary, I'm talking about equity that we've raised that I have deployed into commercial real estate projects, and I take that very, very seriously. Steve said, "How do you find your deals?" In the commercial real estate space, especially the size that we're talking about, it's all about the commercial brokers. The CBREs, the JLLs, those folks, they own those markets. They have all those relationships, and they're doing 99% of those deals. There's the one-off where you might know an owner that has a deal or something like that, but it's very, very different than how you would go about finding opportunities in the single-family space. And so we focus our whole acquisitions team, and we have dedicated people that go after deals. All their job is to develop relationships and rapport with these brokers and go out and find opportunities that way.
Awesome. Ben, if you don't mind, let's bring up your contact information one more time, just in case anybody.
Well, let's see. I don't know how I'll probably fumble around trying to get the presentation back up, but I'll make it easy. Okay. Make it easy. team@disruptequity.com. You can also find Disrupt Equity. We're all over social media. YouTube, Facebook is where we're really, really active at. We've got a lot of free content, and we work with the Quest folks. That's why they invited us on. We love working with the Quest team. They provide a great product. They make it very, very seamless for you guys to deploy money into our syndications. Ultimately, love to see if we can work with anybody on the future projects.
Excellent. Well, thank you so much, Ben, for being here today with us and for that great presentation. I put the email address on the chat as well. So if anybody needs to reach out to Ben or his team, go ahead and do that. But we finished a little bit early. So everybody, you have 10 minutes back.
There you go.
Thank you again, Ben. And thanks everybody for joining us.
Thanks, everybody.
Have a great day.